45 years, 0 name changes, new offices, more staff, improved technology to better serve you. Education, services, investments. Think real estate, think Marshall Reddick. Brokerage, property management, private lending, creating financial independence through real estate since 1979.
All right, thank you everybody for joining us tonight. Really glad to have you. We have an awesome topic that we'll be going over today on unlocking tax savings. It's a very hot topic. A lot of people are asking questions about this. I'm asking questions about this. So my name is Cameron Carlson. I'm excited to present alongside Rob, Natasha, and Rico from Murphy. Very knowledgeable, and they've got an awesome presentation for us as well. Some things that I really hope that you guys get out of this is, one, I hope you learned something. Feel free to write any notes down, take pictures, but not too much, because we're going to send you the slideshow deck after this, as well as we'll send you a recording of this webinar in case you miss anything, or if you want to send it to anybody else or watch it again. And as we go along the presentation, please type all of your questions in the chat. We're going to have a couple times for Q&A later on in this presentation, so feel free to let us know your questions, and we'll kind of address and answer those as we go. Without further ado, let's dive in. So a little about me. I am obviously real estate agent and advisor here at Marshall Reddick Real Estate. I'm licensed in California. I got my bachelor's of business admin from Vanguard University, also local here. I actually started in real estate accounting, interestingly enough. So this is a fun topic for me. I used to do loan underwriting at Marshall Reddick in our private lending department, and I worked in property management. So I got a little bit of everything in my background before being on the full-time advisor side. I've done real estate transactions in 9 states, and I'm also a mortgage fund investor. We'll talk about what the mortgage fund is in just a second. And then for myself, as far as the investment side, I also own real estate. So I'm excited to see how this applies to me, as well as many of you here today. And for some of you, this may be your first time here on a Marshall Reddick webinar. And for others, you may have seen many before. Hold on one second while I'm skipping the slide. Rob, do you mind skipping on your end there?
Second. Cameron, can you hear us?
Yes, I can.
Hold on. I think we may.
Can you hear me? Hello? Can you guys hear me all right? Everyone, can you hear me all right?
We're good.
Yes, is in the chat. All right, one second. Hey, Rob, can you skip to the next slide? I don't think I'm able. It's not loading for me. Hold on one second, guys. We have a quick technical difficulty. We'll get this figured out in a second here. Perfect. Thanks, Rob.
Cameron, I think we're having trouble hearing you right now.
Can you hear me all right? I mean, I have a couple in the chat saying, yeah, hear both of you. Perfect. Awesome. Cool. So a little bit about Marshall Reddick. We're kind of a one-stop shop for real estate, and it's broken up into 4 divisions. First is we are a full-service real estate firm, whether you're looking to buy and sell investment properties or your primary residence locally here, out of state. Marshall Reddick as a company did around 600 total transactions last year. And on top of that, we're a full service property manager. If you're looking for leasing, maintenance, really just for us to take care of your investment, to ease time off of your hand, Marshall Reddick kind of takes care of everything on that end for you. And then we kind of dive into the last 2, which are somewhat similar, but we also offer private lending. Whether you're looking to fix and flip, or borrow a private loan. Maybe you're tapped out on conventional loans, or you have an LLC and you can't qualify conventionally. Well, we offer an alternative. Here with our private lending, maybe you're a borrower, and on the flip side, you can also be an investor. And when you invest, you can invest directly in the loans, or you can join a pool of capital that receives a quarterly return, and that's going to be our Marshall Reddick Mortgage Fund, our investment fund. So that's what I was mentioning earlier. I am an investor there in the fund. So a little bit about us. We're kind of spread out throughout the country, obviously here in Orange County, Los Angeles, Riverside, Bay Area, and then we actually have offices in Texas. That's throughout in New Braunfels, San Antonio, Austin, Houston, as well as we have an office in a couple offices in Tennessee, in Clarksville and Nashville, and then we have an office down in Southwest Florida. And you may be asking, why these states? Why these markets? Well, it's really important as an investor, you know which market to choose. And we actually chose these ones for several reasons. First being is we're looking for markets with strong economic growth, low unemployment rates, and a stable job market. We also want a market where there's a high rental demand. These are markets that are very landlord friendly, and they have a good ratio of renters to homeowners. And oftentimes these markets are diverse in economic industries. We like to see a variety of essential industries, maybe those being military, medical, insurance, communications, IT. Also, it's important that there's a low barrier of entry. Are houses affordable for investors? Maybe the suburbs have more affordable family-friendly neighborhoods. With those family-friendly neighborhoods, we also want to see a good education system. This leads to well-educated tenants that have more desirable school districts, and maybe there's a university in the area as well. And of course, one of the most important property is property management. There should be a good selection of property managers in the market that you're choosing. You don't want to get stuck with 2 to 3 property managers, and if one is not working well with you, you don't really have a lot of options and they're not competitive. It's ideal that you're in a market where there's a good selection of property management companies, so they're competitive with one another, and you know the quality of service has to be good. Otherwise, you'll end up going to a competitor, and that's important, and that's kind of why we chose it. So a little bit about our team. These are some of our offices here. Top left, you'll find our New Braunfels team. Top right is San Antonio. Bottom right is our Clarksville team. And then our Orange County office is down in the center. And then bottom left is our Southwest Florida team. And a lot of what we talk about as far as what your criteria is, what should I invest in, you can kind of set that yourself, and you can find all that on our property rating ebook. This helps dive into what are different property classes. What does it mean to have an A-class property in this community versus this community? How do those property classes act differently? What kind of tenants do I expect? A lot of times those criteria are going to help determine what investment you want to place your dollars in. And so this rating ebook's on our website and available for anyone. Marshall Reddick almost calls it our real estate Bible, but you can go to marshallreddick.com/ebook. And if you want to dive in further, we'd love to schedule a complimentary consultation. You have my information here. You also have Murphy's information. We'd love to talk with you together, see if we can hash out any questions, maybe if we don't answer them today. But without further ado, I want to pass the baton on over to Rob, Natasha, and Rico to continue this presentation.
Thanks, Cameron. Good evening, everyone. It's great to be with you. We're super excited for this topic, unlocking tax savings, mastering real estate professional status for maximum financial benefit. We get questions all the time from clients, from friends, from family that own real estate, that may be looking to get into real estate. What are the tax savings? What do we need to do to maximize our deductions with that? It's actually one of the most misunderstood concepts of tax. The IRS kind of has some loose rules, but we're here to guide you through that today. So we're excited. Typically for real estate professionals, they can be highly audited if there are significant losses. So you want to get it right. You want to work with a tax professional that understands the tax code, the tax law, and can be there with you to guide you through that process. So any questions that come up, we welcome all questions throughout this presentation. Please, if you could just type it in the chat, and then we'll address it at the end. All right, so let's get started. Myself, as I mentioned, my name's Rob. I'm a tax manager. I've been with Murphy for the past 14 years. Got my CPA back in 2015. And I'm going to pass it off to Natasha here.
Yeah, so my name is Natasha. I'm an enrolled agent here at Murphy. I've been with the company for about 11 years now. Started off as an intern, which most of us have. With that being said, I am someone that specializes in individual and corporate tax returns and the preparation of that. I'm a part of a lot of different committees within our firm, but I'm also very excited today about the topic that's at hand and to share what we know about that with you all.
And my name is Enrico, one of the CPAs over at the firm as well. I've been here since 2018, started off as an intern as well, actually working with these guys for quite some time now. But I got my CPA about 3 years ago. Have been working in various industries, but real estate I feel like is a very big one, especially working in Orange County in LA. The real estate's become a really big thing, especially with the things that have been coming up in the past couple of years. So very excited to present you guys with this topic. So we'll go ahead and give you a little bit of background on our firm in particular. So it's really important to kind of know what we are working towards, especially in our firm, and kind of gives an idea of what we want to deliver to our clients. So we'll always like to start off with our mission statement. We've split it up into 3 different parts. First one being to provide the best in professional services to each of our clients with an authentic personal approach. Biggest thing here is that not one story is exactly the same as the other. There's no such thing as a cookie cutter tax return in our firm. We know that each of our clients are a person, a family, and everything. So we want to take that personal approach rather than just putting you through a system that will turn out a return for you. We want to build your wealth with you, as well as making sure that you are in the most know of any tax implications you have in the future. The other part is to provide a personal and professional advancement to each member of our firm. That's for us internally. We want to make sure that all members of our firm feel that they're being supported in their personal ventures as well as their professional ventures, of course, making sure that they are able to get the goals that they want. And lastly is to maintain an environment of friendship and support. Really big here because we're a very big relationship firm, and we want to make sure that first there's friendship with each of the members as well as with our clients, and we want to be able to support each other in whatever avenue that we have and wherever they may need.
So with that being said, you're probably like, what is Murphy? What does this accounting firm in Orange County do? So what that is we have a scope of services that I want to display to you guys today. So what we do is we aid in the preparation of individual and business tax returns. That's part of what we do every single day here. With that being said, we also do some business advisory services where we're able to project out, forecast, and utilize what we call is our outsourced CFO and business accounting to help clients as well as businesses figure out where they are and where they're going to be in the future. Another service that we offer here at Murphy's is tax planning and retirement services. I don't know about you guys, but I'm already ready to do some retirement planning, but also know about what are some of those tax strategies or tax laws that are changing and how they'll aid in my returns in the future. So that's a part of what we do here at Murphy's. Last but not least, we also do financial statement reviews and compilations. So of course, whenever we have clients or businesses that are looking to sell, maybe they need some bank loans and they need some review of those financial statements, that's a service that we also provide here at Murphy's. And with that being said, we do service over about 7,000 clients here at Murphy's. What that consists of is 5,000 being our individual client base and then 2,000 being our business clients. So throughout the year, we're here to help and aid in any services that any of our taxpayers need, which we also consider our family.
Yeah, and we've got a pretty good footprint across the U.S. As far as our client base, which I know Marshall Reddick also has clients pretty spread out as well. So we're well versed in multi-state tax returns if that's what you're looking for with your CPA. All right, thank you both. So now we're going to go over just top level, what are we going to cover in the presentation today? Right off the bat, we want to figure out how to qualify as a real estate professional. There's really 2 big tests to hit. We'll go into more detail on that. Then once we hit those 2 tests, we want to make sure we qualify for material participation. We'll define what that means and how do you actually satisfy the requirement with the IRS. Next, we'll go and see how do we avoid passive activity limits, full deduction of rental losses. So again, at the top of the presentation, we want to make sure you're maximizing the deductions, and we're going to go through a step-by-step couple examples to go through that. Key considerations of real estate professionals. So a couple things we want to highlight. And there's also the net investment income tax. So this was implemented, gosh, I think back in 2009, 2010. It's a 3.8% on investment income. Real estate professionals are not subject to that. So we're going to come up with, and we'll share some scenarios of where it's going to be beneficial for you from a tax standpoint, where you can avoid that 3.8% tax. We'll go over depreciation deductions at the end as well. Just a disclaimer. I'm not going to read this, but we just have this for disclaimer purposes, but let's move on to the first test. So qualifying as a real estate professional. So when you think about this, there's really two big tests that the IRS says for taxpayers that we have to hit. First one is more than 50% of your personal services performed must be in real property, trades, or businesses. And the next slide, we're going to go over what real property and trades or businesses mean with some examples. The second test that we have to hit to qualify as a real estate professional, 750 hours. So annually, we have to hit 750 hours, keep track of 750 hours in order to qualify as a real estate professional. One thing I want to highlight with this one, this is with the IRS, and typically this is where most of our client base doesn't qualify, is the more than 50%. So most taxpayers who have full-time jobs outside of real estate, trades, or businesses usually fail to hit that 50%. If you think about it, if you work full-time, you're typically going to work about 2,000 hours. Now, if it's not in a real estate, trade, or business, you're going to have to work an additional 2,000 hours, even more than that, to even hit that first test. So when we're doing a needs analysis and asking questions with our client base, we usually start with these two tests here. All right, so some of you may be thinking, what are real property, trades, or businesses? Here are just some quick hit examples. Acquisition of property, if you're have time spent on that, construction, development, and redevelopment, rental, and operation. Conversion, leasing, property management, real estate brokerage, including real estate agents, of course. And something interesting with the tax code, mortgage broker of financial instruments actually do not qualify. So if you're a mortgage broker or work under a brokerage house for financial instruments, they are not qualified. So say you work, at Marshall Reddick. Cameron works for Marshall Reddick, and he's, let's assume that he's a W-2 employee. Employee hours can count within the umbrella of real property, trades, or businesses, with the caveat if you're at least a 5% owner in the business. So if I work, and we'll go through this example at the end, if I work for a construction company, I'm a W-2 employee, and I own more than 5% of the business, that'll help with qualifying for those two tests. So that's a huge point we wanted to highlight here. All right, so next, so say we meet those two tests. Beyond that, in order to realize the tax deductions that could come from owning real estate, you have to then evaluate if you materially participated. What do I mean by that? And it's by each real estate activity. We're going to go through that in the next couple slides. If you do qualify, it's considered non-passive, where you get the full deduction of the losses. If you don't materially participate in the real estate activity, it's considered passive, where the losses are either limited up to $25,000, there's some income limits you got to hit, or they're actually suspended and they get carried forward until that activity is actually disposed of for the final year. So yeah, we'll go through that in the next couple slides here. So that's the first topic here, how to qualify as a real estate professional. Now we're going to move on to material participation. So there's really, when you think of material participation, this doesn't just apply to real estate professionals. There's other industries that you could materially participate in to be considered active instead of passive, okay? But for the context of today and tonight, we're going to be going over everything under real estate professionals. So there's really 7 tests, okay? We're not going to spend too much time on this. but we're just going to highlight a couple things. The main one here is the 500 hour. With our client base, typically if they spend more than 500 hours in one activity for the year, they establish material participation, okay? So in one of those industries, okay, so it's 500 hours. That's typically what our clients hit, is the 500 hours. Majority participation. So say you have to hit at least 100 hours and no one else, including non-owners, participate in that activity. So if you got rental property, you spent at least 100 hours, you can't quite hit that 500, you've got 100 and no one else spends any other time more than that, including non-owners, then you would qualify for material participation. That includes like gardeners or contractors that you have coming out in and out of the property to help with improvements. So no one else can have more than that. You just got to hit that 100. We have a couple clients that qualify for that. Substantially all. So this one's harder. Actually, it sounds it's harder for our clients to hit. This is saying that basically you're the only person managing that property. No one else is even involved with that. So the IRS has questioned that with some of our clients. It's easier to hit the number 1 or number 2 of these. Significant participation. So at the beginning of this slide, I mentioned this doesn't just apply to real estate professionals. So beyond the context, this is actually beyond the scope of the presentation, so we're not going to spend too much time on number 4. Prior years. So say you're actively, you buy a property, you're really active in it, but then you have, a good property management company like Marshall Reddick, they come on board and you're kind of hands off. Well, say the first 5 years, 5 of the last 10 years, they don't even have to be consecutive. You actually hit number 1. You spend 500 hours. You're automatically grandfathered into material participation for that rental property. So it's actually pretty interesting there. So that's for prior years participation. Personal service activity. This is, again, doesn't apply specifically to real estate activities beyond the scope. This one's kind of a catch-all. So based off all the facts and circumstances, if you can establish that, the IRS, it's kind of like their catch-all. If you can't really fit the box with some of those other tests, but you can prove based off the facts and circumstances, they may allow that. Okay. But typically you'll see number 1, and you may be thinking already in your mind, if you own property or you're looking to invest, can I actually substantiate the 500 hours of majority participation? Those are usually the ones that are easiest to prove. All right, so say you do that. Each rental property is treated as a separate activity. What do I mean by that? We're going to use an example here. So 500 hours. So say you've got actually 2 properties. For this purpose of material participation, they're treated separately. So you've got to test each activity separately. So right now we're just using 2 rental properties. This first one, we've got about 50 hours a month, which is 600 hours annually. Second one, only 13 hours a month that you're actually managing it for 160 hours. So when you're running this test, there's separate activities. This one is non-passive because you hit that 500-hour test. And you get full deduction of losses. Say you have a lot of improvements, and for tax purposes, you can actually deduct that. For the second property, because we're under that 500, you're actually passive. So the losses are limited again, or they're suspended and carried forward for future years. So pretty interesting there. The tax code does allow this. It's called a single activity grouping election. And you want to be you want to plan this out. You want to speak with your tax advisor to make sure you're thinking of all angles when you're making this election. What this does is it permits taxpayers to treat all interests in rental real estate as one activity. Why do we want to do that? It's easier to hit one of those 7 tests, right? So it's a tax return election you make in the year. So you file it on your tax return. It's a statement that you elect, and you say, all right, these 2 properties I want to group under one activity, and it's a permanent election for all future tax years unless details change significantly. So going back to that example here, if we make this election, you can kind of see what happens here. We file that. If Murphy was doing your tax return, we went through the different scenarios, made sense. We would make this election on your tax return. What happens is you combine the time. So what that does now, you've got 600 hours on the first property, only 160 hours for the second. You combine the 2. Now you're above the 750, and combined you're over the 500. Any repairs that you have in either properties that trigger a tax loss or improvements would be fully deductible on your tax return. And what I mean by that, that could offset your spouse's other, if you have a spouse, or if you have other sources of income, that'll be in the same bucket as that income, and you get a full deduction. So there, you could really realize significant tax savings by doing that. I know I just went through a lot. You may be having questions. I'm hoping you're including your questions in the chat here. What we like to do is go through, some of us are visual learners, so we have a flow chart. We'll just go through an example here. And in this example, we'll go through all the way as an example if you're qualifying as a real estate professional and you hit the material participation. So with that, again, the first two tests, 750 hours in real property businesses. Yes, you would move on. And then are more than 50% of your services in real property. Okay, so again, going back to the full-time position, if we got to quantify the total hours in the year, is that more than 50% of all the other services in real property? Then you'll make that decision. Do you want to elect all your real estate activities as a single activity? That doesn't just go for real properties. So I know some of you may have investments that are held, real estate through K1s. You could also elect that to be within the same umbrella of one activity for real estate professionals. So you make that election. If it's combined, which in this example we're saying it is, we highly recommend, we'll go through some tips and tricks of adequate records for participation hours. Do you have that for the combined activities? If yes, then you would be considered non-passive as a real estate professional, and then the losses are fully deductible. Mm-hmm. So you can kind of see that's the process we like to go through with our client base, when we're doing tax planning and so forth. So just a helpful guide for you. I know Cameron mentioned we'll provide this to you if you're going through that, if you're thinking if you qualify or not. All right, so we want to drive home these concepts with a couple walkthrough examples. So we're going to put our thinking hats on here.
Okay.
And we're going to go through a walkthrough example. I'm going to hand it off to Natasha and Enrico here. We're going to go through this.
All right, Enrico, you want to start?
All right, so we got our first example here. We have Bob the builder, okay? So Bob, he personally owns 3 rental properties in California. He utilizes Marshall Reddick for property management, spends 200 hours per year on managing each of the properties, 600 in total, okay? He works at Build It Right, a real estate development company. Very important that we hammer home that part, right? And he's working full-time, but he's also a 10% owner of the company, as well as he receives a W-2. So what Bob did, he talked to his tax professional. They talked about it, and they said, you know what, it's probably a good idea to aggregate all 3 of the properties together to make it one single activity, okay? So that's example number 1. And then we got Doug Dimmadome over here. He is our second example, and he works at a dude ranch as a ranch hand, okay? He may not look like it, but he's a burly guy. And so he also has 3 rental properties, but he spends most of his time at the ranch, so he doesn't have any time to work on his rentals, okay? Marshall Reddick also takes care of everything for Doug's rental properties, so he basically has no time. He's only at the dude ranch, so that's just another example that we have there.
All right, and now let's talk about Patty Mayonnaise. So Patty is also a W-2 employee. One thing about her is she is a mortgage loan processor. With that being said, she is a part-time employee. With that, she does own a home, her personal residence, but she also has 3 rental properties, 2 in Texas and 1 in California. She uses Marshall Reddick as her property management services, but some key things we want to keep in mind is that Patty does have good record keeping, or she doesn't have good record keeping. She utilizes Excel, which a lot of us do every day. And that's when she often remembers to update it. So that's probably not too good. She does use Marshall Reddick, and she provides them also with all the information they need for all 6 bank accounts that she has. But she co-mingles some of her personal funds and her business activities on certain cards. So one thing we want to make sure is that we kind of have a separation there. She does spend about 825 hours in a tax year, but when we're looking at the material participation of her properties, it's between 450 to 625. So the question is, does Patty qualify? So one thing I want to point out on this slide in particular is we want to kind of look at her part-time employment. This is an area of opportunity where we can say, hey, is there another position or another job function that she has? Is she allocating maybe a little bit more time to those rental properties where she would qualify? And then also making sure we're realizing that even though her properties are in different states, she can still qualify to aggregate those properties if she qualifies for those tests that we went over just a while ago. So with that being said, that sounds like a lot of information. So let's look at our next slide to show you guys how that looks, because some people are visual learners like myself. So as you can see here, Bob does qualify as a real estate professional and is able to aggregate his properties. What that means is we are showing that he's a full-time employee, but he's a 7% owner of that business, right? He also spends $200 per se on each property in terms of hours. So he's able to aggregate all those properties and also make sure he's considered a real estate professional. With Doug, if you look at this slide, Doug is a full-time employee, but he is not an owner of the company that he works with in the industry that he's in. So because of those reasons, and because he doesn't pass any of those tests that we mentioned before, he has to actually carry forward his losses on all the properties that he has, which is at $25,000 to future years once that investment property or so starts to make money. Now with Patty Mayonnaise, the one I just mentioned before, we have scenario one that we just talked about where she's a part-time employee. She has about 150 hours spent on that real estate property for each property. So with that, there's a little bit of a maybe she could qualify, maybe she couldn't. So in scenario two that you're looking at, we kind of highlighted how she's able to qualify as a real estate professional and take all those losses on her tax return. So if she's a part-time employee, she's giving about at least 1,080 hours. Like Rob mentioned, full-time is close to about 2,000 hours. So that 1,000 hours, let's go ahead and talk to the IRS. Hey, we know we are putting in a lot of time on these rental properties. We were able to bump up that 150 up to about 208 per property of hours being spent throughout the year. That means she never sleeps. So with that being said, she's able to aggregate her properties. We also highlighted that she owns her own business, which is a staging business. She's 100% owner. So that's how she's able to qualify as a real estate professional, aggregate her properties, and still take pretty much all those losses that she was taking onto her tax return for that current year. One thing we always want to mention is that even if we have clients who have horrible bookkeeping when it comes to their properties or any of their work that they're doing, Marshall Reddick is a great source for them to utilize so that they can get on the right path to making sure everything is done properly for their managing of their properties.
Thanks, Natasha. So I think it's good. It's jump in the detail. We really do look at that. It's a client by client scenario. We really want to figure out the facts and circumstances, see if we can make sure they qualify. And again, the realized tax savings are here. So if it's not deductible, you carry it forward. But if you can make the case for the year and you do qualify, it offsets, again, all of your other sources of income. All right, so a couple, just to bring home a couple points. So key considerations, detailed record keeping, highly recommended. We'd love to, if you have more questions about that, of what that looks like, we could schedule another meeting to figure out, how do you keep track of it. Some clients keep track of it on an Excel sheet of how much time they actually spend per property, managing the property. And if they're doing research, I'm gonna take my hat off. Second, this is interesting when you'll see, I know most of us are probably in California. California does not conform to real estate professional designation. So it's an IRS designation that is under the tax code for IRS for federal purposes. California has not conformed to that. So when you think about real estate professionals, the losses are typically going to be just always passive and carried forward for California. So you'll see a federal versus state difference. Again, at the beginning, I mentioned this 3.8%, kind of like a surtax on investment income. So if you got portfolio income, rental income, it's assessed every year going back to 2008, 2009. So 3.8% net investment income. Real estate professionals would be exempt from that. So if you have rental income every year that's generating profit, it's exempt from that. Okay, so say some clients, say you make the election, you've got some Airbnbs or some short-term rentals, and it generates a healthy profit. If you are able to establish real estate professional and material participation, all of that income every year would not be subject to that 3.8 saving, 3.8 tax which could be pretty significant. This 3.8% kicks in once your income, married filing joint, is over 250. If you file separate, 125, and single or head of household, 200. That's when that 3.8% kicks in. You really realize, and this is where we work with our clients to tax plan. You're not only looking at the current year, you're looking at the second year or third year, 4 year out. What happens when you sell an investment property for tax purposes? You pay capital gains on that, right? So if you're a real estate professional, you could realize some significant savings because the 3.8% would be subject to the entire gain on that rental property. So for example, if you sell your rental property, say you made a significant gain, $500,000, 3.8% of that would be $19,000 of additional tax that you would realize under this net investment income tax. So if you qualify for real estate professional, you could avoid $19,000 just by making that election on the tax return. Moving on, depreciation. So when we think of losses on rental properties, typically when you buy a rental property, there, if it's a fixer-upper, there may be additional depreciation on that, and accelerated depreciation. So we get excited at that with accelerated depreciation because it gives us options as your CPAs to strategize on your tax return, right? So there's bonus depreciation. Some of you may have heard of this. There's currently legislation where they may go back, but for the longest time, it's been 100%, and that's now starting to get reduced 20%. It was 80% in 2023. This tax year, it's 60% and 40%, and then 20% in 2026. And this is for property with a under 20-year useful life. Okay, so your improvements, if you got like an HVAC system that you have on a commercial building, that's under 20-year property. You could do up to 60% this year, that first year. You wouldn't realize actual savings unless you're a real estate professional and you have material participation. So could be huge. Increased deductions in early years of ownership. And as I mentioned, there's tax planning opportunities. This may just be one bucket of your overall tax situation. There may be other things. You may be getting a bonus that your spouse or significant other may be getting a bonus, and your income is projected to be higher in the next year or two. Maybe we realize or defer some of that depreciation for future years. So it really gives us an opportunity for us to tax plan with you all. Another thing which we could spend this may be the next topic or presentation we tackle is cost segregation studies. So if you buy a property up front, typically, if it's 39-year property or 27 residential property, typically the building is over 20 years. But you could actually do a cost segregation study and say, hey, actually, of the 39-year property, the commercial building, these items qualify for bonus depreciation. And what that happens is you can actually realize that up front. Okay, so again, just further planning opportunities.
And something that we always love to do is, like Rob is mentioning, is we like to talk to our clients, forecast what the future looks like. Just because when it comes to depreciation can be a tricky thing where, let's just say we take that 60% in 2024, we take the remaining 40% over the useful life of the asset. We can always elect to where, hey, in 2025, we're actually planning on making a lot more money. So maybe we need to divert some of that depreciation, that accelerated depreciation, to future years if possible, because it makes more sense. Which is why we always want to say tax plan with your tax professional, especially if you guys are planning on selling or doing any type of upgrades and remodeling to any of those properties that you have.
Yeah.
And then the other part too is very important that you have your tax professional or talk to your tax professional, because as Rob mentioned, that there's still legislation right now about it's supposed to be dwindling down for bonus depreciation, but there is possibility that things can change very, very quickly. This is an election year, so things are really, really volatile right now. It's a good thing to make sure that your CPA or whoever you have preparing your return is very well informed and keeps up to date with the updated tax law.
Got it. Thank you. And some of you may not have actually filed your 2023 tax return yet. And if you do have real estate in your portfolio, there's still time to actually do a cost segregation study. There's still time for us to strategize, even though we're past the calendar year, because you file it on your tax return. So I've got a client that's actually doing a cost segregation study, and it's going to affect this year's taxes. So there's still time to strategize. All right, with that, I think we talked about, the two big tests to qualify as a real estate professional, more than 50% of real estate trades or businesses, and then the 750 hours. If you hit that, then, we tested for material participation, those 7 tests. What that does, if you do hit that, you avoid the passive activity limits, and you can realize a full deduction of rental losses. Some key considerations of real estate professionals, how to avoid the 3.8% net investment income tax, and then we just talked about depreciation deductions. So in a nutshell, we went over a lot today. So I think we wanted to kind of open it up for Q&A time. And we'll share this information. Cameron will send this to all the attendees today. Here's our contact information. So with us, with Murphy's, you've got a team. It's not just one, CPA that you'll be working with or EA. We've got a full-time staff of about 80 to 90 full-time professionals. So you've got the years of experience here with MMM. And here's our contact information, our email address if you want to schedule an appointment or consultation. Oops. Okay. I think that's it.
Awesome. Do you want to start going over the questions there in the chat?
Yeah. Oh, right there it is. Yep. Okay.
Okay, cool. So we got it.
First question there was going to seminars count towards the 750 hours? And how about listening to them?
Great question. Typically, continuing education does not qualify. Yeah, great question. I like how you're trying to add up the hours.
Yeah, you can deduct it as an expense.
If 3 days outside town for seminar, how would you calculate hours for seminar? Let's see here. I'm not sure. If you could please elaborate on if 3 days outside town for seminar. So maybe travel time is what you're thinking of?
Yeah, I think they're traveling to go to a real estate seminar. Like how would they qualify?
Okay, I see that. Typically you keep track, so say if it's travel time, if you're doing research on a property, if you're traveling and looking for property to acquire, you actually keep track of your travel time. So the flight, the time spent on the property, travel to and from would substantiate that. Anything to add here? Hi, Denise here. Can we count at Marshall Reddick property management time towards a 750-hour requirement?
That's a good question.
So if it's an outside party that's doing the property management, technically it'd be your time spent on it. So Denise, it would not qualify. That would be the outside, if you remember the example of having like property management company supporting you or gardeners, those would be non-owners. So if the property management company is actually spending time, that would not be included in your 750-hour requirement. That's a great question. So think of you individually, how much time are you spending on that?
Now, what about like the time that you spend with that company? For instance, if you spend like 5 to 10 hours a month with that property management company.
That'd be helpful. Yeah, that would work.
And that's what you want to track. Again, we're looking at the material participation. So if you are meeting with Marshall Reddick, let's say for 5 hours a week or whatever it could be, that time does go towards the 750 or 500 hours. But when you're looking at just Marshall Reddick doing the job of doing whatever the property management is, that is separate. And that would be considered the expense of the rental property.
Yeah, great question. Do all managing members, this is a great question, in LLC qualify for the real estate professional status if one, the LLC is strictly focused on real estate? Good examples there. Development, redevelopment, property management, leasing. Number two, all members are involved in the decision-making process in some way, and every member spends at least 750 hours per year on the LLC. All members have a full-time job, 2,000 hours a year in a non-real estate industry. This is a great question. So do all managing members in LLC qualify? So number one is strictly focused on real estate. Yes. So that those would qualify for the actual activity. Every member is involved in the decision. That would qualify. And then every member spends at least 750 hours per year on the LLC. That would also qualify. Now, this is where, if you remember, the 50% time on the, let me go to the exact verbiage here. So spending 750 hours, what that does is more than 50%. So if they work full-time jobs in non-real estate or non-real property trades or businesses, sometimes it's hard to meet that. So in other words, if you've got 2,000 hours, you're 750, so you'd have to double the 2,000 and you'd have to have 2,001 hours in real estate, right? So just to keep it simple, say you have 2,000 hours in a non-real estate business, you have a different W-2 job, you have to hit 2,001 hours to qualify for that more than 50%. So the 750 hours would qualify. You've got to find another over 125 hours, 1250 hours in that, or sorry, 1250, right? 1250. So it is tricky to hit that. It's not impossible, but 3,000 hours, think about it, 4,000 hours, that could be quite a bit. So.
And Rob did mention this earlier too in the presentation. This area has been an area that in the past has been highly audited. So when it comes to the record keeping, let's just say you are questioned about your return and they want to approve some things. Again, even if we're saying, hey, we have a full-time job, we've allocated so much more time to the real estate, that's something that you can always fight in your case and say, no, I actually had a lot more time allocated to my rental properties. Again, I never slept, but I did allocate time to these rental properties to where you might have a fighting case if that is questioned.
Yep.
That's a good question.
Great question.
Yeah.
I think all hit except that last one, the 2,000 hours a year. There could be interesting scenarios where if you have say you file a joint tax return and one of the spouses doesn't have a full-time job, right? It may, if the other spouse that does not have a full-time job actually shows as the member of the LLC, then you may be able to qualify for real estate professional. So there's some interesting planning opportunities there when you look at the facts.
Yeah.
But the significant other has to hit the two tests. You can't hit one and the spouse can't hit one. That doesn't, you can't combine it. One of the spouses has to hit both of those tests. Let's see here, moving on. How many years can you carry over your passive loss deductions?
Excellent. That's a good question. That one's easy because it rolls forward indefinitely. So until they're used up. That's one of the, I guess, good things. If you have all these passive losses for multiple years in the past, and then say you end up trying to sell your rental property, that's when all those passive losses are then released. So then they'll go against that capital gain that you'd be getting on that rental property when you sell it. So yeah, the short answer is indefinitely.
Yeah.
Right.
And that tax law changed back in 2018. So until there is legislation that changes again, it is indefinite.
And that's by activity, just to add Enrico's point. So if you got one property that has been accumulating losses, once you sell that property, it frees up that property's passive losses, not all the other ones.
Right.
So if you've got other properties, okay? And it's important to make sure those are carrying forward. There's a spot on the tax return to carry forward those accurately. So if you ever switch accountants, we always want to make sure if we get a new client and someone has passive losses, we make sure that that's carried forward appropriately.
Right.
Great question. See if I'm hitting these questions here. Okay. far as I understood, the only way to become a real estate professional and having write-off, I have to be a business owner to begin with, correct? You do not have to be a business owner, actually. So say you invest in properties, and you don't have to necessarily be self-employed. We have real estate professionals that are self-employed. They have their own corporation or they're sole proprietors. But it really goes down to the facts and circumstances. So if you can quantify those hours, and you hit those tests, you don't have to be your own business owner. Yeah.
There is potential, say that you're retired and then and all you're doing now is managing your properties, or all you're doing is spending all your time in rental properties. If you're not working those other hours, and it's literally just you're retired and then you go to your properties, that will count you as a real estate professional.
Yeah, I have a client that preferred to do all of the improvements, all of the repairs himself, and he qualified based off looking at the time logs of how much time he spent per property. He qualified. So you don't have to be your own business owner for that purpose. I hope that answers your question. Let's see here. Did you mention where on the 1040 I would say I am a real estate, I'm assuming real estate real estate professional? You mark it by activity. So there's actually a spot on there to mark it as on the Schedule E. Yeah. So on the Schedule E, Schedule E page 1 or page 2. If you're using a tax software or your CPA is, they should be pretty comfortable with, they should know where to mark that box. Yeah. The election is an actual verbiage that the IRS says, hey, if you want to elect to treat them all as one activity, that's a special election also that you would make on the tax return. So. What do you recommend when a property is fully depreciated?
So this one's kind of a case-by-case situation. So I would say this one in particular, I would say definitely talk to your tax advisor on this, because this is only one small piece of a tax return. There could be much more to this. What other kind of income you have. There's other opportunities for some tax savings that they could be looking at as well. Just this one piece is it wouldn't be enough information for us to really give any kind of recommendation, really.
Yeah, I know we mentioned cost segregation earlier on. That's typically done for properties that are not fully depreciated, so you can have an opportunity to reclassify some of that to shorter useful life and maximize the bonus depreciation. So if we're thinking in the context of cost segregation, it's typically property that you've owned maybe 5 to 10 years max, but it doesn't hurt to kind of do a needs analysis. So when it's fully depreciated, we may be asking you questions of like, are you thinking of selling this property? Maybe utilizing a 1031 exchange, we'd figure out your cost basis and kind of run some different scenarios on that. So.
And big picture too is depreciation is looked at as an additional expense you're taking against your income. So if you fully depreciated a property, you're still going to be able to take expenses that you have towards your business, including any of your advertising, your upkeep, any other additional expenses to write off against that income. Because ultimately what we're trying to do is lower what income we're reporting to the IRS, but accurately based off of the expenses you have, including depreciation.
Great. Henry Lee, can you group short-term rental and long-term rental management time to meet the 750 hours? That's right, you can. So think of anything under the umbrella of real estate activities. If it's through a pass-through K1, through short-term rental that you may own personally, or 50% with someone else, that time would be, you can group it together. Now, once you make that election, it is, and there could be scenarios where it actually is just, not in your tax benefit to make that election. If you have passive losses, for example, going into that and you make that election, those passive losses kind of get frozen. So there could be scenarios, and it's unique, as we've been mentioning, to the client, to the taxpayer. But yes, you can elect to meet that 750 hours. one more time, because CA does not accept real estate professional. What does it mean? Okay. So that's a good point. So in the context of real estate professional, typically real estate activities, just 10,000 foot approach, are considered passive activities, right? So what that means is any losses are suspended. However, income you have to recognize in the current year. So that's in a nutshell a passive activity. There's a special code if you hit those tests to qualify as a real estate professional. For IRS, they allow you to now free up any of those losses to deduct against W-2 income, portfolio income. So that's an IRS election or designation, federal designation that you get. California treats that still as passive. So if you have income generating property, it's still considered as passive. You still have to recognize income on passive income. Losses are passive losses for California. It's important to also maybe mention that passive losses can offset passive income. It goes into a separate bucket. So you've got your passive income in one bucket, you've got your ordinary income in the second bucket. Ordinary income typically is like your W-2 income. If you own your own business, you're hands-on, that could be ordinary income. Passive goes into a separate bucket, and they typically don't offset each other. So California does not recognize real estate professional, so you'll usually see a difference between federal and state. So hopefully that answers, Suzanne, your question.
I think we have time for one more question.
Okay.
Yeah.
I can't see how many. If you invest in real estate through syndications and spend time evaluating properties invested in, which was one of them, right? If you invest in those properties, can the hours spent, yes.
Yeah.
Can the hours spent, sorry, I should read the question. Can the hours spent evaluating the properties count? The answer is yes.
Yes.
So yeah, if you're spending time researching, I have a client that is in the business of acquiring properties for construction. So they do a lot of research into figuring out what the best location is, market, so forth. You can use that time to hit those tests. Great question.
Quick question, Rob. If I you fly out to tour properties in another state, can I qualify the entire trip, or how do I break that down?
That's a great question.
Usually it's based off of the majority of time that you're spending. If you're going, let's say, to Alabama for 5 days, and 3 out of the 5 days you're using to work on this property, go search the property, do whatever you need to do to keep that property going, you absolutely can take the full cost. But if there's any time less than that 50% mark, then technically it's considered that you're not going there for the business.
Yeah, and to add to that, this is why we mentioned this is one of the most misconceived concepts of tax. The IRS gives varying guidance on it. There's court cases that actually they allowed the travel time. If it's for personal use, if it's directly business use, that's probably going to be our first question. Did you actually have a little side trip? Do you visit family while you're going to research properties? We wouldn't include the personal time with that. Okay, so really dives down to the detail. But yes, generally.
And to that point too, Cameron, your best friend's going to be the best record keeping you could possibly do. You know, to the point of having like some sort of calendar saying, okay, I spent these first 3 hours, you know, talking to my grandma in Alabama, and after that, I went over to check out properties for the next 5 hours.
Yeah.
The more detail and the more information that you have and what you were doing in that travel time will be your best friend to really plead your case, saying like, hey, no, this was actually a research and development trip that I was doing for this business, for my real estate business, and you know, that's going to help you the most.
Okay, and with that, I think that was the last question.
Well, yeah.
Okay.
I think that's it.
Oh.
Right on time.
Prompt.
Thank you, everybody.
Yeah.
We appreciate you joining us tonight. Feel free to let us know if you have any questions. We'll obviously be sending you a follow-up with the recording as well as slide deck. Let any of us know, and we're going to hop on a call with you, hop on a video call one-on-one. Love to dive further into some of the topics that we discussed today and answer even more questions.
Thank you.
Thank you guys so
Bye,
much.
everyone. Thank you.
Have a good night.
Everybody, take care.